In today's video, we're going to cover all things insurance: homeowners, renters, auto, life, pet insurance, umbrella insurance, and even travel insurance. I'll be covering everything that you need to know about each type, and then tips for making sure that you're covered when you need it the most. So let's talk about homeowners renters insurance first. Any homeowner will tell you that things can and will always be breaking. Trust me, they will. Water heaters burn out, and then roofs always seem to find the most inconvenient time to need replacing. Enter homeowners and renters insurance. Generally, homeowners insurance will cover destruction and damage to your home, the loss or theft of possessions, and personal liability for harm to others. I don't think there's really a question of whether you should have homeowners insurance or not. I mean, you should, right? Since most mortgage lenders require it. Also, depending on where you live, natural disasters like floods, hurricanes, and earthquakes are often excluded and require separate riders or policies, basically additions to that policy. Renters insurance works similar to homeowners insurance in that it's there to protect your personal property. Renters also offers liability coverage, but damage to the building is the responsibility of the landlord who actually owns it, right? And that's covered by their homeowners insurance. Here are some tips when it comes to homeowners and renters insurance. First off, document everything. This can be as easy as making your own MTV Cribs video, going room to room to capture everything that you own on video. For expensive electronics like TVs, computers, etc., it's worth writing down the model and serial numbers somewhere in case you need them. The reason this is important is because if you ever need to make a claim, how else would you know all the list of things that you lost? Like, you'd probably remember the big things, but there's a bunch of little things that might be very valuable that you lost. Document everything. Next, compare prices. While I wish there was a perfect comparison site, I often have to go straight to the company's websites for this one. A nice hack here is that the quizzes about your home size, the roof material, are often just to help you figure out how much coverage you need. So, once you know that number, you can put whatever you want to get to the end, and then you can just dial up the numbers to exactly what you want. Also, you don't need to wait until the end of your policy to make a change. I found this out personally. If you switch in the middle, you'll just get a check for the difference. So it's okay if you pay for all up front and then change halfway through the year. You'll get that money back. Get your discounts. Alarms, especially if they report to local police or fire sprinklers, and security cameras can reduce your premiums by as much as 15 to 20%. That's a lot. You may also get a discount for an organization you belong to, or if you're eligible for military-related insurers, you can check them out too. Bundle with auto. This may help you save money, but don't assume that it's always the best. For us, we saved hundreds of dollars bundling our homeowners with our auto policy more recently. Raise your deductible. This one's interesting. A deductible is the amount that you pay for services before your insurance begins to pay. For example, if you have a deductible of like $5,000, but you have a claim for only $1,000, you just gotta pay for that $1,000 out of pocket. If you have a claim for more than $5,000, insurance will cover it. Statistically, the cheapest insurance should be self-insurance because insurance companies make profits, right? However, very few of us have enough in our emergency fund to rebuild our home, nor do we want to take that risk. That said, if you have enough emergency savings or just general cash buffer to cover a higher deductible, it can be a great way to lower your premiums. Have enough coverage. If your home has appreciated, which if you bought before 2020, probably has, the cost to rebuild has likely also gone up as well though. So keep an eye on the value of your home and rebuilding costs so you can adjust your policy as needed. I like to review this annually. Insurance companies don't really adjust this for you, right? According to inflation or any other type of benchmark. You gotta do it yourself. On the other hand, dial back coverage that you don't need. This varies by policy, but a specific example is around loss of use, which covers putting you up in a nice hotel or similar rental home if you can't use your home. If you have a second home or family that you could easily stay with, you might not need this, so you can dial back the coverage and forego that loss of use. High value items are not covered. It's important to note that if you have fancy jewelry, art, bikes, cameras, or other high value items, you'll probably need an additional insurance rider for those items. Now, it varies by policy, but a common threshold is about $1,000. So anything below that is covered. Anything above $1,000 on an individual basis is not covered typically. Also, these policies aren't that expensive, often costing just a few $100s a year. Auto insurance. According to the Association for Safe International Road Travel, about 4.5 million Americans are involved in a traffic accident that requires medical attention. That doesn't even touch on the cost of time off work, vehicle damages, rental cars, possible litigation costs, and so on. So car insurance, it's a must-have. Here are some tips for auto insurance. Compare prices. The same advice that we talked about for homeowners or renters insurance above applies to auto insurance, but it might be even more important. Prices across different auto insurance providers can significantly vary each year. Raise your deductible. Same advice goes for homeowners, renters, or auto. Low mileage savings. If you don't drive much, there are a lot of companies that actually offer pay-as-you-go insurance that often involves adding a device to track your driving. If you're driving less than about 10,000 miles per year, this could make sense. But even if you don't find good pay-as-you-go rates, you can select a lower number of miles per year with any policy and often get a lower rate. Pay in full. Many insurance companies charge a fee to pay your bill monthly or weekly or so on, so you can save by paying in full or at least every 6 months. Increase your credit score. In some states, although not California, insurance companies charge less if you have good credit. So if you have a credit score below 700 or so, check out our video in the description below to learn how to improve your credit score. Good grades. Students can get discounts for having good grades as well. Liability umbrella coverage. I didn't know what this was a few years ago. So while home and auto policies can cover your personal liability for accidents in your car or home, their coverages may not be enough. For example, your auto policy might offer, let's say, $250,000 of liability coverage, but that doesn't mean you couldn't be sued for $1 million for an accident involving a serious injury or death. In fact, in some states, you can be sued for future earnings. So if you have a higher net worth or are a high earner, your home or auto policies might not offer enough liability coverage. That's where umbrella or personal liability insurance comes in. It sits on top of your home and auto policies and then covers your liability for as much as you want to pay for it. Umbrella policies typically aren't too expensive, usually costing between $100 to $400 per year for the first $1 million of coverage, and then about $100 for every $1 million in coverage after that. Pet insurance. Pets, and I can talk about this from a personal example, are a walk-in example of Murphy's Law. Whatever can go wrong will go wrong. And while pet insurance can be a good option for any pet owner, it might be more interesting for those with exotics like birds and reptiles that require special care, as well as those with breeds prone to health issues, like flat-faced dogs and cats with breathing issues. Now for pet insurance, premiums are usually about $15 to $100 a month, but vary widely depending on age, breed or species, and previous health history. The older the pet, the higher the rate. Ultimately, I think pet insurance is a really personal decision that comes down to how much you'd be willing to spend on medical treatment for your pet. If that number is like more than $10K, then pet insurance might make a lot more sense. Also, it's important to note that pet insurance is typically a reimbursement style. So you'll pay for services up front and then you can submit your claims to be paid back. One hack to get credit card rewards. Life insurance. When you have children, you suddenly have a newfound responsibility to provide financially for that child and the rest of your family. If you were to pass away, you might want to be able to provide for your children at least through the age of 18. And this is where life insurance comes in. A life insurance policy is a contract between you and an insurance company in exchange for regular payments called premiums. The insurer pays out money after you die. This payment goes to the people that you choose as beneficiaries, which is usually children, a spouse, or other family members. It can be an important safety net if anyone depends on you financially. Beneficiaries then can use the money to repay debts, replace your income, or provide funds for future expenses like college tuition. Some employers do offer some form of life insurance, but it's typically not a significant amount enough to cover long-term loss of income. Now, term life insurance works by covering you for a limited period of time, such as 10, 15, or 20 years. You can choose a term length that matches your needs, and then, if you die within that term, your beneficiaries receive the payout. Ideally, by the time the term ends, you no longer need life insurance, as your house will be paid down, your kids will be grown, and you'll have some money saved up to go to them. Term life policies are often the cheapest type of coverage, as they don't build any type of cash value, but instead are meant to cover the loss of income for the beneficiaries. Permanent life insurance. Permanent life insurance costs more than term life, but offers additional features like a cash value account, which grows over time. Whole life insurance is the best known type of permanent life, but other types include universal life, variable, and variable universal. Permanent coverage can provide money for your heirs, regardless of when you die. So when it comes to life insurance, how much should you get? Okay, so no matter which type you choose, you just want to consider these main expenses that the policy would cover in the event of your death. Outstanding debts such as mortgage, personal loan, or credit card balances, everyday living expenses, and that includes childcare, utility bills, groceries, and car insurance, future expenses like funeral costs and college tuition. So you'd want to use these main factors to determine how large of a policy you actually need. That way all those main expenses are covered. Here are some more life insurance tips. What kind should you get? This is where life insurance gets very confusing, so I'll keep this short and sweet. For most younger people, term life typically makes more sense. It just does. If you pass away within that term, your beneficiaries get the face value of the policy, called the death benefit. If you pass after the term expires or simply just age out of the term without renewing it, they get nothing. Okay, but that then begs the question, why go with term life insurance if it might expire? It hopefully does, right? Well, the reason, it's a better deal. Other permanent, aka whole life, universal policies market themselves as offering you a benefit that lasts your whole life, which is easy to do when they have much higher premiums, complex rules, and really high fees. You're almost always better off taking what you save with the lower premiums of that term life policy and investing those savings in a diversified portfolio of low-fee index funds. Check out Wealthfront for this. Disability insurance. Anyone at any age can become disabled and unable to work for long periods of time, whether it's from illness or injury. So how do you make sure that you're financially covered should you have an accident or sudden illness that prevents you from working? By having some type of disability insurance in place, especially if your income supports more than just you. There are two main types of disability insurance. Short-term disability, which usually covers you up to about 6 months, or long-term disability, which can cover you for a few years or until you retire, but usually has a waiting period of 3 to 12 months before kicking in. Many of us might be offered or given short-term and long-term coverage through our employers, or have access to short-term disability through a state fund such as California residents do. While those policies might replace 60 to 80% of your income, they often have weekly or monthly caps that might result in them replacing a much smaller percentage. If those policies are not enough, or if you do not have coverage from work, you can also buy full or supplemental policies on your own. If you have enough of an emergency fund to cover living without your full income for 3 to 6 months or so, you might find it easier to self-insure your short-term disability needs through an emergency fund, or at least self-insure the difference between the coverage you have and your full income. However, unless you're financially independent, you probably won't be able to self-insure against the chance that you become disabled for the long term. So, if you don't have a policy through work, you may want to look into one. Or if you don't have enough coverage from your employer to live on comfortably until retirement, I'd suggest looking into a supplemental policy. It's also worth pointing out that there is a Social Security disability insurance and supplemental security insurance. These FICA taxes that you may see taken out of your paycheck are what funds these programs. Because of this, you need to have paid into these services for a certain amount of time to be able to use them. Luckily, most of us have hit the threshold of 40 work credits or about 10 years of employment. So if you're unsure how many credits you have, you can then go and check through the Social Security Administration website. We'll link in the description below. Travel insurance. In the past few years, airlines have been pushing travel insurance everywhere. Remember the last time you bought a flight? How many times did you have to decline it? If you book your flights using a top-tier credit card though, most of these offer the travel protection you need without buying any supplemental policies. That means they'll cover things like delayed, lost, or damaged bags, trip delays, cancellations, or interruptions, medical evacuation and emergency medical treatment, rental car collision damage, and even more. This coverage does vary widely, so I definitely recommend finding your guide to benefits online and then confirming what your credit card does cover. But with this coverage in place, I'd feel pretty good about traveling without other insurances, except for a few circumstances when it comes to maybe your health. Like, if your health insurance doesn't cover you while you're traveling abroad, you might want to consider a travel insurance policy that covers non-emergency medical treatment. Or like, if you plan to do adventurous activities like scuba diving or rock climbing, those might not be covered under your existing health insurance policies. So I'd look into travel insurance that will cover these activities. If you're going swim with great whites, maybe just get it either way. All right, thanks again. This is Tony from Wealthfront. Take care.